Today, the market did exactly what confuses most investors. Stocks moved higher, not because of big news, but because pressure quietly eased where it mattered most. Let's break down what actually drove today's move. U.S. stocks traded higher today, led by large-cap tech. SPY and QQQ both pushed up steadily through the session. There were no major headlines, no surprise economic reports, no emergency news from the Fed. Instead, today was about rates, positioning, and relief. Let's start with the 10-year Treasury yield. Earlier in the session, yields pushed higher, but then stalled and began to stabilize. That matters because yields have been the main headwind for equities. When yields stop rising, pressure on stocks eases. Today wasn't about falling yields, it was about yields no longer accelerating upward. For equity markets, that's often enough to trigger buying. Looking at SPY, we see a classic intraday pattern. Early volatility, followed by steady upside momentum. Buyers stepped in once it became clear that yields were not breaking higher. This wasn't panic buying, it was controlled, methodical accumulation. That tells us institutions were active, not chasing headlines, but managing risk exposure. QQQ outperformed again today. That's important. When tech leads during a rate-sensitive session, it signals improving risk appetite. Investors weren't pricing in aggressive growth, they were pricing in less downside risk. In simple terms, today was a relief rally driven by stability, not optimism.
The key question now is simple. Can yields remain stable? If Treasury yields stay contained, stocks can continue grinding higher. But if yields resume climbing, equity momentum will likely stall again. For now, the market is telling us one thing. Pressure eased, but uncertainty remains. If you want a clear, no-noise breakdown of the market every day, subscribe and check back tomorrow. Thanks for watching.